Welcome to TACOS Tuesday. I'm Hamish Conway from Sal Global, and unfortunately today we do not have Sebastian Hargraves and all his advertising expertise. Today we're going to do something a little bit different, and I'm going to share with you some fascinating insights into the Amazon Australia 2024 filing results. For those of you who are new to the TACOS Tuesday podcast, Sal Global, we're an Amazon specialist marketing agency with a specific expertise in Amazon ads. We're actually an Amazon Ads Advanced partner, which puts us in the top 5% of ad spend managed in Australia. And we work with all sorts of brands. And while we have a big focus on Australia, we still have clients in the USA, Canada, and the UK. And look, we just are focused on really helping brands be successful on the Amazon channel. And hence, this is one of the key reasons why we are doing this podcast. Now, on the 3rd of March, something important happened that I've been waiting for, and that was the Amazon Australia ASIC filing for their 2024 results. And so while it's topical, I thought I'd do a bit of a deep dive into that and look at some of the numbers beyond the top level revenue and just see, well, how is this relevant to you as a brand who sells on the Amazon channel in Australia? So I'm going to dig up some interesting insights. So look, I'd seen I knew it was around this time of year that it will come out, and I'd seen a post. Someone put some top line revenue numbers in there, and it's like, right, this is out. And I thought, okay, how do I actually get my hands on this report? And so I went to the ASIC, which is Australian Securities and Investments Commission website, which is really old school, by the way. And so I was putting in Amazon Australia and coming up with, and just the search function was really poor, and I wasn't quite getting the right thing. And then I ended up going to amazon.com.au and looking at the terms and conditions, and I found there that the company I needed to find was actually Amazon Commercial Services Pty. So put that in, and then I could see the report, and I had to pay my $49 to get the report, and it downloads, and I get it. And actually, if you're watching, I'll share it here, but it's not exactly very exciting. It's all just black and white and very just formal document numbers here, and it's got all the auditor report, and then it's got some numbers at a very high level. It's got statement of cash flows and operating performance and balance sheet, and then all these different notes and some like unbelievably boring things around tax. And so you got to kind of dig into the 30 pages until you get to the good stuff about page 17, and then more other notes from there. But anyway, so we got that information, and actually, because I used to be an accountant, as it turns out, out of university it was Coopers and Lybrand as it was back in the day, showing my age. It's now PwC. And then also I had a period there where I had an accounting firm for 2.5, 3 years before selling that. So I can read some financial statements. So we've got a bit of that background there. But anyway, also a question I had is, why do they even need to file these reports? And as it turns out, it's because they're a large proprietary company that is not a disclosing entity. So they're not a public listed company, but they're a large proprietary company. And so I looked at, what does that mean? And it's actually a surprisingly low bar. It means two of these three things: that $50 million in revenue, or over 25 million in assets, or 100 employees or more. So actually any company in Australia that is doing that actually has to file. Anyway, bit of information there for you. So what we're looking at, though, is these results are from the 31st of December year end. So they do a calendar year, does Amazon. Now, I've found 5 key numbers I'm going to dig into in more detail, and then I've got about 9 or 10 numbers that are just kind of interesting that could be good for barbecue conversations. So let's dive in. I know you're listening to this here. I have got some slides that I'm talking to as well. If you're on YouTube, obviously you will be able to see those. Okay, now here's the first number that I want to share with you, and that is the online store revenue. Look, the total revenue is 3.8 billion for the Amazon Commercial Services Company, which is, I'm going to dive into some of the other revenue lines as well, but this is one of the key ones that obviously people are interested in, the online shop where consumers are going to buy, and the money that they give Amazon to buy the products on the platform, whether they're first party or third party sellers there. So here we go. Now I've actually in the report, it only has 23 and 24, but I've been tracking this for a little bit. So I've actually got the 2021 numbers as well. So out of interest, back in 2021, they were doing 886 million. In 2022, it was up to 1.293 million. So that was like a 40% increase from 21 to 22. And this is where the whole COVID situation was very helpful for boosting sales online. In 2023, it was up to 1.567 billion. I should be saying billion here if I got that wrong in the last one. And that was a 21% increase. And then in 2024, it's up to 1.936 billion. And that's a 23.53% increase year on year. So that's quite meaningful, actually. And then even if you were to look at the 21 to 24 increase, that's 118%. So it's more than doubled. And even in the last, looking at 22 through 24, that's a 50% increase there as well. So that it's growing fast. And I was like, well, what other channels are actually growing at this rate? And for context, like Bunnings Group, they're at $19 billion in revenue. Their sales are up 2.5%. Their online, I've heard, is only 2% of their overall revenue. So that's approximately 380 million, by the way, what they're doing. But then you look at the biggest retailers in terms of Coles and Woolies, obviously, these numbers are bigger. Established retailers, been around forever. So Coles, though, they do 43.6 billion, and their e-commerce component is 3.7 billion. So Amazon's about half of that, which is interesting. And Coles' e-commerce part grew by 9.2. The overall was less than that. And Woolies, they're 67.9 billion, and their e-commerce is 7.96 billion. So that would actually probably make them the biggest e-commerce seller at the moment. And Amazon is about a quarter of what they're doing. Woolies e-commerce was actually up 18.5%. So that I kind of find that interesting, just to get that context of what is going on. So while Amazon is certainly growing, Woolies is not too far off the pace. In absolute terms, it's there, but certainly, and I'll show you something in a moment, and talk to it as well, is the where this is really heading for Amazon, which is still very young in its in its time in Australia. And even if we're just looking at a marketplace point of view overall, eBay, they'll be down 33% based on SimilarWeb and seeing their traffic having dropped by a third. So it might even be down by more than that. Catch, they're gone. From a marketplace point of view, Amazon is certainly, by far and away winning that game. And I believe Amazon at the moment is only really 5% of online sales. Now, I thought it was more than that. I thought it was near a 10%, but Amazon plays to win. In America, it's got 40% of the e-commerce, of all e-commerce. And so that's a significant number. So there's a lot of upside to go. And they will, I said, they play to win. They will dominate the online space even more this year as shoppers really embrace the fast delivery and selection. So while Coles and Woolies, they're all around FMCG type products, Amazon does have everything. And the fast delivery is going to kick in even more. So I just want to share for those of you that can see it. And it's looking at the Amazon North America sales. And we know Amazon's always played a long game, and this is like the perfect exponential curve. And in the last 10 years, their revenue has grown by 6 times. So I think this is what's going to happen in Australia as well. It will grow at that similar rate, which would make it, goes from 1.9 times 6, it'll get up to 12 billion in the next 10 years, kind of going at that rate, because it will go exponential. That's just the way that they play. All right. So that's the first aspect there. Sales growth, and in the context of the rest of the market, it is leading that growth, and it will only continue to really grow. I'm expecting it to it might even grow more. I just think this same day delivery, they've invested heavily in warehouses and the fulfillment delivery side of things, and customers are now starting to really gotten onto it. And there's also from an advertising point of view, which I'll share later, there's a lot happening there as well. Anyway, the second key number I want to talk about is Amazon Prime membership. Now, in their accounts, it is called subscription services. We know that this is Amazon Prime. There could also just be Audible in there, but the bulk of it is going to be Amazon Prime membership. And this is up 38.77%, up to 480 million. Now, doing some back of the envelope maths here, Prime membership monthly is $9.99. Prime annually is $79. So quite a big delta there for annual versus monthly, 120 versus 80 basically. And in my research, and typical SaaS, like software, who takes monthly versus annual, and it's 80% will take the monthly option over the annual option. So I've kind of applied that. And then that got me the average of $112 per year. And dividing that by that 480 million, I got to 4.289 million estimated Amazon Prime Prime members. And I had actually last month we had an event in Sydney, and I was catching up with some people, and I heard from a pretty reliable source that they're at 5.1 million at the end of the year in terms of Prime members, and Amazon was expecting that to go up to 5.8 million. I was thinking, well, that's kind of interesting. But when you look at the maths here, they grew from 22 by 40%. They went from 246 million to 346 million. So it grew by 40%. And then in 2024, it grew by another 38, nearly 39%. So that continued rate of growth, another 40%, would get them to that 5.8 million. And by the end of the year. Now, why is that relevant? That is relevant because there's going to be another 1.6 million Australians who have the ability to get the free same-day shipping in main centres. And that is a lot of shoppers there that you can be tapping into. That's why you want to be paying attention to that. They will like the low-risk approach to the purchase. They will like the customer service from Amazon. And look, this is just where shoppers are shopping. So you want to tap into that pipe. That's the whole game, right? Yes, Coles and Woolies, if your products make sense for that, obviously that's going to be your biggest. But you can't ignore just what is happening with the Amazon number of shoppers there and where those sales are going. Now, tied into this here, like if you are selling on the platform and you want to access that Prime members, you need to be using Amazon's warehouse for fulfillment called FBA if you're a third-party seller, or if you're selling to Amazon wholesale, it'll automatically fit into that there. Anyway, so that's just something I wanted to add into. So you want to check that, which products make sense for your FBA, because when you are, your conversion rate will double because of the free shipping. So keep that in mind. Okay, moving on to the third key number. Now, this one here is third-party seller fees have gone up substantially, 47.63%. So they were up to $839 million. So Amazon Commercial Services, they receive $839 million from third-party sellers and that is made up of the referral fees, the commission that Amazon charges from 8 to 14%, and that'll soon go to 15%. And also, if they use the Amazon FBA warehouses, they're paying a per unit fee for that. And there'll also be some storage, and then there's some miscellaneous fees like whatever it is now, $39 or $49 a month for membership, and then some other miscellaneous ones. But $839 million. So that has gone up by 47%, which would indicate that there are a lot more third-party sellers. And I've mentioned in other content that when Amazon started out in Australia, it was all vendor, like 85, 90% vendor. But that has shifted, it's swung definitely past the 50%, and it may well even be at that 60% third-party sellers now. And what's interesting is half of those sellers are from China as well. And so the impact there is that there's, they will by default be having lower prices. That's just what happens there. That means it's going to be getting more competitive on the platform if you are a third-party seller, You've got to be, your offer has to be compelling. It doesn't mean it needs to be the cheapest. It has to be compelling, and that value equation that consumers are making in their mind, you've got to really nail that. So you cannot be lazy with your brand content or with your product listing content. You really have to raise your standards there, because a lot of these sellers coming in internationally into Australia, they are Amazon hardened. Selling on Amazon USA is really difficult. It is so competitive. We know most of the sales happen on page one, like 80 plus percent. And to get on page one in the States, you've got to be on your game from a brand content point of view, from a search point of view, paid search as well. So this is happening. So it is now time to really be, you cannot be taking this for granted. The sales you're already making, you can't be taking them for granted. It is time to really take this more seriously. Otherwise, you'll find you're going to start to decline. And we've got some clients with massive catalogs, and there's some products and brands within those catalogs that do compete directly with a lot of these overseas sellers, and their sales are flat or declining there if they haven't been given attention. So that is something that you want to be really paying attention to. Then actually another interesting point here that I've got highlighted, and if you are going to use FBA, I think you really need to weigh up the cost of that versus you doing it through another means, who you're using to fulfill on your own e-commerce site, because Amazon is actually pretty price competitive. And I know, well, in my previous episode there with Carl Pronti, like he actually prefers people to buy off Amazon because it's actually, they can't compete with the delivery speed and or timing. So it's really one to look at. And I think a lot of brands, not a lot, but some brands, as Amazon really kicks in, they're starting to go, well, jeepers, Amazon's getting quite a big percentage off my sale price. They've got the commission there, then they've got the FBA fees, and if there's advertising, and then the percentage is starting to get a bit bigger. And that percentage can scare people, but actually they're not really factoring in the freight component that they would otherwise also be having to charge the consumer. So the offer's not as good on your own website. The shipping can be slower, less reliable. Anyway, the point is you want to examine this and maybe even test what is working best. Anyway, so third-party sellers increasing. 1P is increasingly just tending to be bigger, known brands. Amazon just knows those products will sell, so that's who they're being proactive with, even though I have heard that they were looking to get on anyone as a vendor. So they're looking for growth, as well as the third-party team who compete against each other to get sellers. It's kind of a weird scenario. And then the other thing that is a bit strange at the moment, even when we look at the context of Coles and Woolies and Amazon, the Amazon retail team, just how hard they are playing ball at the moment. They are really trying to flex, and it is quite surprising the brands that they're picking on, and they are just playing hardball. And it's really, and there's an attitude there of, well, the brands are just going to have to bend to our will. So it's going to be interesting to see how that all plays out. But Amazon at the moment in retail there, they just think that they've already won. And so they're negotiating as if that. So yeah, that's why a lot of people are choosing 3P or even looking to switch to 3P, because they just cannot be bothered with the attitude of the retail team when it comes to negotiating. Anyway, that's number 3. Moving on to number 4, Amazon ad revenue explodes by 58%, and it's gone from 153 million to 242 million, up 58%. Now, this was like only back in 2021, it was 63 million, 22 it was 101 million, and then already we're up to 242 million. So that's nearly 4x over the last 4 years. And the way it is growing, so it's growing at plus 50% every year. And I've got a forecast in there for you as well. And I'll see this being at $363 million over this next year, because it might even be higher actually, because I've got Prime TV ads coming in. There's a lot more happening around DSP, the Amazon Marketing Cloud, and getting brands to look at a full omni-channel advertising strategy. and because they will be able to start showing brands that the data that they can act on, that's going to make it much easier for them to invest. And the attribution from first click through to last click is going to give brands the confidence to invest more. This is going to be a fascinating part of what we see, particularly it's going to be more, the bigger brands that'll be doing this because they've got the budgets and the ability to do it. But actually, even for mid-range brands, this is something you want to start playing at as well, because the competition won't be, and this is going to start giving you an unfair advantage. But the key is, like, no one minds investing money if they know it's working, and this is what Amazon is going to be showing, and that's the key part there. The attribution, because of its walled garden, is actually really accurate compared to a Meta or a Google, where that attribution is not always making sense. So what else have we got here? We've also got non-endemic advertising will boost revenues. With such a large consumer pull and purchasing data and behaviors and also those other demographics, what is non-endemic is advertising that isn't about driving products on the website. It's thinking about technology companies wanting to get in front of these customers, finance companies wanting to get in front of these customers, automotive and travel. They're going to start advertising on Amazon ads assets. So that'll be something to really look out for. I know as an agency, we're looking to get involved in that space because Amazon ads is our expertise, and that there will boost their revenues even more. So it's going to be interesting just to see where that lands. So maybe my 50% might be a bit conservative. We shall see. And I think what we're going to see is, looking at the whole marketing mix, marketing managers now, marketing directors are going to be looking at Amazon and going, maybe from a brand building point of view, particularly for CPG products, we need to be spending more of our money on Amazon. Now, if you're a smaller brand trying to compete, you're going to get outspent. And so you've got to be really smart then and really efficient in the way that you run your advertising. You cannot be lazy with it. You have to be right on the money, and you've got to find where there's gaps there that you can start winning, because cost per click is only going to increase, and that is something that you're going to need to be paying attention to through this next year. All right, that's number 4. Getting up to number 5 now. And so this is a little bit different. This is an expense line that's called sales and advertising. Now, this could be, what they spend with Google. If you search in Google for a product, an Amazon ad can come up. On Meta, other digital billboards, footpath signage. I know, like, there's massive billboards you get out of the airport. They're there. Footpath signage. I think I did a post on like 15 different design assets coming up. It might have been, I think it was probably that. So that, and on TV, and it could be possibly sales teams, print and sponsorship, etc. But they increased their ad spend from 336 million to 447 million. It was $111 million increase, or 33% increase in their advertising. Which other retailers increased their advertising budget by 33% in the last year? I would suggest not many, if any. So this is an indication of how aggressive they are getting. What I did as well is I thought, well, okay, off their revenue, you've got that shoppers are looking at. You've got their store and you've got the subscriptions. I added those two together, and then I divided the advertising spend by the store revenue and subs revenue, and the advertising is 18% of that revenue. That's actually pretty high for a retailer. That's how aggressive they're being. And if you look at, you go, well, a lot of the advertising is actually also helping get new sellers onto the platform. So if you add in the third-party seller fees and the advertising fees as well, then, and just taking out related party, it still is 12.79%. And they've been consistent with that. Like in 2023, it was 17.59 for stores and subs. 2024 is 18.52. And then sales X related party in 23 was 12.77. 2024 was 12.79. And so my forecast then is they're going to spend another $100+ million more. 559 million was my forecast there, just increasing it by 25%, and that'll be in line with those percentages there. So that said, who else? I mean, you as a seller, you get to benefit from all that investment that they are putting on to get shoppers onto the platform. And this is why this exponential graph keeps on going. They will invest aggressively to win. And so you want to be there. It's like it's just plugging into the pipe because that's where the shoppers are going to be looking. It's just like another $100 million of advertising spend is going to bring way more eyeballs to the platform and your products being there. So that there again is just too hard to ignore. And they're smart because more people go there, and then this is the Amazon flywheel. We get more shoppers, it attracts more sellers, and those sellers actually will spend more on advertising. And because it's more competitive, there'll be better offers there, and there's going to be more selection because there's more sellers, which then attracts even more shoppers. And so the cycle continues. And this is the Amazon flywheel in action. So that's an important piece there. And also, if it attracts more sellers, it increases their third-party seller fees as well. All right, so they're the 5 big numbers that I wanted to share with you. And now I've just got to finish off some quick fire numbers that I found kind of interesting. And this is their gross profit percentage. So you've got net product sales, net service sales. So you've kind of got their store sales and then service sales. That adds up to $3.8 billion. And then it's got their cost of sales. So their cost of sales is anything to do with buying inventory, the fulfillment centers, and the delivery vehicles. They are all in around that cost of sales. So their gross profit percentage is 42%. It was 42.25% in 2023, and in 2024, 42.15%. So that's actually pretty solid numbers there. Then you've got their general and admin expenses, which is I break some of it down, but anyway, the upshot is that from an EBIT operating income, this is before any financing or tax side of things there, in 2024 they made a $38 million profit, which is actually a 1% profit. So how good are those accountants there at Amazon? They know how to whittle down their tax bill. So in the year before, they made a 0.6% profit. Now, so they're making a profit. There's obviously a bunch of other capital going in and investment going in, and there's depreciation and amortization and all of those kind of accounting things there. But I thought it was kind of interesting. They have been paying some tax. They paid $22 million in tax, but actually a massive portion of that was actually for their employee share benefit tax. Was like, and I'll show you another one's like $45 million of share benefit, and they had to pay tax on that, which was about $17 million. So anyway, so the company itself is figuring out how to pay tax, but not too much. All right, and what else have we got here? So fun facts, they have 3,681 employees as at the end of the year. So 3,681. So I was like, okay, that's interesting. Revenue per employee is $1 million and 35. Should have had a dollar sign there, but $1 million per employee, which is kind of on par probably with a lot of these bigger tech companies. Some of them, Google might be a little bit different there. Now they have, so in terms of what they paid people, is called short-term employee benefits. So that was $366 million, which would mean the average per employee is basically $100,000 in terms of what they pay. And they have all this stock-based compensation, which is $45 million, which is about 12% of their short-term employee benefits. So they do have that. That'll be one benefit, I guess, if you work there, is the stock options. Depending on your role, you would have that there. So anyway, I thought that was kind of interesting. But then check out this number here. Professional fees. Now, this could be contractors. It'll be accountants, lawyers, and engineers and all sorts. But it was $241 million in 2024. That's a big number. Compared to, from the employees, it was 366. This is not far behind. So maybe the auditors, Ernst and Young, and the accountants, what are they, Piper? They're getting paid pretty well. So if you are in the professional services game, there's some budget there for you if you want to get after it. Anyway, so I thought that was kind of a big number, because you put that into the context, right, of the tax that they're paying. It's just, where does this money go? Anyway, some other interesting quick fire numbers. Just the last slide here to finish off. Inventory. So they're carrying $333 million of inventory as at the end of 2024. And most of that inventory, for it to be in their books, would be what they've purchased from first-party vendors. Okay, so that would be what that's from. Maybe some international stuff, but we'll just keep things simple, call it vendors. Then another interesting, and I'll get to another interesting number on that, but under this one, I've got inventory write-down. They allow for basically a 10% inventory write-down, $30 million of stock that's either expired or damaged. So that's actually quite a big number. I was quite surprised by that number there. Again, there's a context we probably don't know, but that's the number that comes up. So then I was just trying to get interesting. The accountant in me goes, well, how much stock are they carrying compared to these sales? So I was looking at the store sales for Amazon.com.au, and they're $1.97 billion. And if we're looking at first-party sales at a retail value being 40% of that comes out to $788 million. And then I was doing the, how many months worth of stock are they holding on hand there? And at the retail value, at least, they've got 5 months worth of inventory to be carrying. So I thought that was like quite a bit. There's obviously going to be some fast-moving stuff and some slow-moving things, and I'm sure that'll be a number that they'll be looking to reduce. Obviously, writing some down, but I thought that was, it was quite a lot of stock to have on hand, given the estimated vendor sales. Actually, if I'm to be accurate, a lot of the big sellers on Amazon, now they've done this, I'm probably a little bit flawed on this, because the vendors, whilst they might make up a percentage of the actual number of sellers, those sellers tend to be much bigger, in the tens of millions of dollars that some of those sellers are doing. Anyway, so my maths might be off here, but anyway, that's where we go. That's where we're at. And then just another number that I saw in there, lucky last number, was construction in progress in 2024 was $239 million. Now, it seems mostly they are leasing. I don't know if it's to a related party or not, but vehicles and buildings, they're leasing. I think they had like $630 million of lease obligations there. So, but this construction, obviously, there's all the building improvements and the equipment that goes in. More just to point here to that they are continuing to build out their infrastructure for fulfillment, and it's only going to continue to get stronger and continue to get better, and the customer experience will get better as well. Anyway, so there we go. That is my deep dive on the Amazon Australia 2024 ASIC filing results. So I hope you found that interesting. And as we were going through there, we looked at the advertising revenue increasing, what in terms of ad spend from sellers and their own advertising growth. And what else we got here? Third-party sales increasing, Prime numbers up, revenue up. So it's interesting times, and we will see what happens in 2025. And I just think there's a number of things coming into play for Amazon that will have more shoppers coming to the platform as they actually get used to, oh my God, this actually turned out really quickly. And what else can I buy? What else could I buy? That's interesting. So I think that's what we're going to see. Anyway, I'll leave it at that. I've gone a little bit longer than we normally do on this podcast, but I thought it was worth a deep dive beyond just the top line revenue numbers that some other people might have shared. Anyway, if you found that useful, leave a comment, subscribe, flick us a message at Cell Global. Would love to know if you found that useful. If you want to get, if you're watching, you want to get those slides, I'll turn that into a PDF and flick me a message on LinkedIn. Hamish Conway there from Cell Global. Thanks so much. Really appreciate you tuning in, and we'll see you next week for another Tacos Tuesday episode where we'll have Sebastian back and sharing his Amazon ads expertise with us. Okay, all the very best. Thank you so much. Bye.